Press the bell icon on the YouTube app and never miss another update.
Friends, welcome to another video on your channel Profit Inequities. Now if you like our content, please don't forget to hit the like button. Also subscribe to our channel and click on the bell button to receive notifications at the fastest opportunity. Now East India Securities is a prominent brokerage house in India. Here we present 4 stocks which they think could turn out to be multi-baggers going forward. Also friends, please don't consider any of these to be stock recommendations on our part. Please go ahead and do your own research, consult your financial advisor prior to acting on any of the information that is ever presented on this channel. Please watch this video to know more. Now the first company on the list is Piramal Enterprises Limited, which is available at rupees 2853.15. The code for the company is PEL. Now Piramal Enterprises Limited is engaged in the business of pharmaceuticals, including research and development, financial services and information management through its subsidiaries. The company's pharmaceutical business consists of manufacturing and sale of owned and traded bulk drugs and formulations. It operates through 3 segments: healthcare, financial services and information management. Now if you were to look at the 1-year chart for the company, you would see that for the initial part of the year it was on an absolute uptrend, but since then has largely been consolidating. The market cap of the company is 49,299.04 crores, which means that the company is a large cap one. The EPS is 81.2264, which translates into a price earnings ratio of 34.46. Now this is a little bit more expensive compared to the industry PE of 30.80. The book value for the company is 834.70, which translates into a price to book ratio of 3.42. The dividend yield here is 0.74, whereas the promoter holding is 51.34, which is marginally fallen in the last quarter. The debt to equity is on the higher side at 2.6896, whereas the return on equity is 0.0956. The 52-week high is 3088.95, whereas the 52-week low is 1661.00. Now, the company is being highlighted by East India Securities because in a span of just 5 years, PEL has evolved to become one of the largest real estate financiers in India. The NBFC business, largely catering to real estate developers financing, is expected to remain on a robust growth path. In 2013, PEL acquired 10% stake in Shriram Transport. It followed this up with the acquisition of 20% stake in Shriram Capital and 10% stake in Shriram City Union Finance in 2014. With these investments, PEL has also diversified into retail financing. Also, PEL is the 3rd largest player after Abbott and Baxter in the global inhalation anesthesia space. PEL's consumer product business is the 7th largest among all OTC companies in India. It has a good portfolio of high branded products, and these are the reasons why this has been outlined as a potential multi-bagger going forward. Now the second company on the list is Nitin Spinners Limited, which is available at 112.85 on the National Stock Exchange. The code for the company is NITIN SPIN. Now Nitin Spinners Limited is engaged in the textile business. The company manufactures cotton yarn and cotton knitted fabric. Now if you were to look at the 1-year chart for the stock, you would see that essentially the stock has not done much and has largely been range bound. Now if you were to look at the market cap of the company, it's 623.15 crores, which means that the company is still a small cap one. The EPS for the stock is 9.4, which translates into a price to earnings ratio of a decent 12.01. The industry PE here is 11.78, which is a little below what this company enjoys as its price to earnings ratio. The book value is 48.09, which translates into a price to book ratio of 2.35. The debt to equity is 1.6529, whereas the return on equity is 0.2058. Now the promoter holding for this company is 53.36, which is on the lower side. The dividend yield is 1.06. Now the 52-week high for the company is 144.90, whereas the 52-week low for the company stands at 76. Now if you were to look at this particular company, the reasons put forward by the analysts are: Nitin Spinners Limited is a Rajasthan-based manufacturer of 100% cotton yarn and knitted fabrics with an installed capacity of 2,25,000 spindles. Now this has very strong promoter pedigree. Now this company is promoted by R.L. Nolkha, who has spent around 25 years in the industry before setting up NSL. Over the last 25 years, this family has grown the business very efficiently and has successfully navigated the challenges and threats posed in the industry. Also, the company's expansions have been prudently planned in order to keep gearing in check, and the management has consciously capped the interest cost to sales at 5%. Also, the company has been successful in maintaining best among the industry operating metrics, resulting in a healthy ROAE to close to 27%, 24%, 25% for FY15, FY16, and FY17 respectively. This company is also trading at an attractive valuation of 9 crores FY19 estimated earnings. Now the third company on the list is Westlife Development Limited, and this company is engaged in letting out of property and trading in goods. The company's segments include trading and leasing. The trading segment is engaged in trading of steel, textile and other materials, whereas the leasing segments provides office premises on operating lease basis. Now if you were to see, the code for this company is WESTLIFE and the price for the stock is 350.40 currently. Now if you were to look at the 1 year chart, you would see that towards the last half of the year, the company has enjoyed a good price movement on the upside. The market cap of the company is 5451.28 crores, which means that the company is a mid cap one. The EPS is 0.12, which translates into a very expensive price to earnings ratio of 2920.00. But here, while considering this very expensive figure, we have to understand that this company is on the verge of a turnaround, and this number is going to substantially improve going forward. The industry PE here is 75.90 and the book value for the company is 30.83, which translates into a price to book ratio of 11.37. The debt to equity is 0.4474, whereas the return on equity is 0.0066. Now, if you were to look at the promoter holding of the company here is 62.17, which is decent. The 52-week high for the company stands at 388.80, whereas the 52-week low is 184. Now, another factor to note here is that this company did not pay out any dividends, and hence the dividend yield here has been mentioned as 0%. Now, if we were to go at this particular company, the reasons put forward are: the Indian food retail market is the 6th largest in the world and is estimated to grow to rupees 61 trillion by 2020, posting a CAGR of more than 15% over a 6-year period. Now, QSR segment contributes 16.3% to overall sales of food retail division. Now, Westlife Development Limited enjoys certain competitive advantages like long-term rent agreements with a longer tenure for acceleration on a relative basis, which leads to faster store break-even periods. The company continued with the strategic and consistent expansion of its store base by setting up 22 stores in FY17. Now, these are primarily the reasons why East India Securities thinks that this company could turn out to be a potential multi-bagger going forward. Now, the final company on the list is Agrotech Foods Limited, and Agrotech Foods Limited is engaged in the business of marketing food and food ingredients to consumers and institutional customers. The company offers its products under various categories. Now, the code for the company is ATFL, and the company is currently available at rupees 723.55. Now, if you were to look at the 1 year chart for the company, you would see that towards the middle of the year, the stock was on a consolidation spree, whereas after that, the stock has had a positive price movement. The market cap of the company is 1763.24 crores, which means that the company is still a small cap one. The EPS is 12.59, which translates into a very expensive price to earnings ratio of 57.47. Now, this is very much expensive compared to the industry PE of 26.09. The book value here is 147.67, which translates into a price to book ratio of 4.90. The dividend yield here is on the lower side at 0.28, whereas the promoter holding here is also average at 51.77. Now the 52-week high for the company stands at 814.70, whereas the 52-week low is 462. Now if you were to look at the reasons put forward by East India Securities, this company has its sales growth figures which are expected to pick up, clocking 22% YTD FY18, doubling the growth rate from 11% during the year ago period. Now nachos is a nascent but fast growing segment in India, and agrotech has become the number 2 player in this market. Also, the company plans to launch different flavors and spin-offs of peanut butter combination with jelly or chocolate, and this is expected to clock sales of rupees 400 to 500 million, and they expect it to touch rupees 1 billion by FY21. Also, the company has 5 plants currently, and the 6th one is under construction at Chittoor. Once the company has its 7-plant model in place, we should see better growth in RTE popcorn, and these are primarily the reasons why East India Securities thinks that this could be a potential multi-bagger going forward. Now friends, please don't treat any of these as stock recommendations. Please go ahead and do your own research, and also none of what you see on this channel should be construed as our opinions. Thanks for watching, and we will see you soon with another video.